this. Have you ever found yourself staring at a company's financial reports, feeling like you needed a decoder ring just to understand what you were reading? You're definitely not alone. Today, we're cutting through that noise to give you a really clear understanding of a truly major player in the airline industry.
Absolutely. We're about to dive deep into the complex world of Delta Airlines, Inc., ticker symbol DAL, to bring you a focused and hopefully digestible financial analysis. Our aim is to synthesize a mountain of information from official reports, financial data platforms, pulling out the crucial insights that truly matter to understand Delta's journey.
Right, our mission in this financial analysis is ambitious. We want to extract the most important nuggets of knowledge regarding Delta's performance, its unique ownership structures, and the incredibly significant challenges and opportunities it has navigated from 2020 through 2024. Think of this as your essential shortcut to being well informed about Delta's financial health and their incredibly strategic moves during a truly tumultuous period for the industry.
And before we go any further, a crucial point, one we really can't emphasize enough. This discussion, while thoroughly researched, is for informational and educational purposes only. It is not not financial advice. We strongly encourage all of you, our listeners, to conduct your own thorough research and, most importantly, consult with a qualified financial professional before making any investment decisions. Our sole goal here is to present the facts and the key insights we've gleaned from the available data, doing so as impartially as possible.
Okay, great. So, to begin this financial analysis, let's truly set the stage. What exactly is Delta Airlines, Inc. at its core, and what were its defining characteristics as we entered this fascinating yet incredibly challenging review period?
Well, at its heart, Delta Airlines is a Delaware corporation providing scheduled air transportation for passengers and cargo across the entire globe. Its operational network is intelligently centered around a number of core domestic hubs. Think of places like Atlanta, Minneapolis-St. Paul, Detroit, and Salt Lake City. These aren't just airports, they're strategic fortresses, really. They're distinguished by very strong local passenger shares, a high penetration of deeply loyal Delta customers, a highly competitive cost position, and critically robust margins.
So those are the big inland hubs, the power centers.
Exactly, but their reach doesn't stop there. They also operate significant coastal hubs in key high-revenue markets such as Boston, Los Angeles, New York LaGuardia, New York JFK, and Seattle. These hubs are designed not just for volume, but to provide a strong presence in large revenue markets, enabling considerable growth in their premium products and extensive international service.
And internationally, where are their main connection points?
Right, stepping beyond the domestic sphere, Delta maintains a really significant international footprint. They have crucial international hubs and market presences in major global cities like Amsterdam, London Heathrow, Mexico City, Paris Charles de Gaulle, and Seoul Incheon. This incredibly extensive global footprint isn't just about their own planes either. It's greatly enhanced by a number of incredibly strategic relationships with international airline partners. It's a truly vast, interconnected web.
That sounds like an absolutely impressive and strategically built global reach. Can you give us a sense of the sheer scale of their day-to-day operations and their fleet leading into this review period? It must be truly mind-boggling to coordinate.
It absolutely is. I mean, consider this. As of December 31st, 2022, Delta and its various alliance partners collectively served over 130 countries and territories and more than 800 destinations worldwide. To put that into perspective, that translates to offering over 4,000 daily flights across 6 continents. Imagine the logistical puzzle of that.
1,000 flights a day. Wow.
Yeah. And to support this massive network, Delta's own fleet comprised approximately 1,250 aircraft by the end of 2022. This isn't a static fleet, it's a dynamic one, varied in size and capabilities, providing crucial flexibility in adjusting aircraft to specific network needs. The company also wasn't just maintaining it, they were actively engaged in refreshing this fleet by acquiring new, more fuel-efficient aircraft, often with increased premium seating and higher cargo capacity, specifically aiming to replace older aircraft and, importantly, reduce overall fleet complexity for better efficiency.
Okay, so beyond just passenger flights, which is what most of us think of when we hear airline, what other businesses contribute to Delta's overall operations? It sounds like they have a few other interesting irons in the fire, some of which are quite unique.
They absolutely do, and these related businesses are not just side hustles. They are crucial components of Delta's operational and financial strategy. One significant arm is their MRO, which stands for Maintenance, Repair, and Overhaul Operation, known as Delta Tech Ops. This isn't just an internal department. It provides extensive maintenance and engineering support, not only for Delta's own fleet, which, for context, comprised around 1,100 mainline and regional aircraft back in 2020, but also services a wide range of external aviation and airline customers globally. So they're a service provider in their own right.
Okay, tech ops, that makes sense. What else?
Another arm, perhaps more familiar to leisure travelers, is Delta Vacations, their wholesale vacations subsidiary, which bundles flights with hotels and other services for third-party consumers. But perhaps the most unique and financially critical of these related businesses is Monroe Energy, LLC.
Ah, yes, the refinery. Tell us about that.
Right. This is a refinery located near Philadelphia, and it's truly a standout. It's capable of refining around 200,000 barrels of crude oil per day. Its primary purpose, and this is the key insight here, is to mitigate Delta's jet fuel costs for its airline operations.
How exactly does owning a refinery help mitigate fuel costs? Seems counterintuitive sometimes.
Well, it does this by producing not just jet fuel, but also a range of non-jet fuel products like gasoline or diesel.
Yeah.
These are then strategically exchanged with third parties for the jet fuel consumed by the airline. It's almost like they've become their own specialized gas station, giving them an incredibly unique lever to pull against the notoriously volatile global fuel market, effectively managing their fuel supply chain and costs in a way no other major U.S. airline does.
That's a truly surprising and unique strategic asset. Okay, now let's turn to 2020, a year that saw an unprecedented global event. How did the COVID-19 pandemic impact Delta's financial performance? We know it was an incredibly tough period for all airlines, but the numbers for Delta are particularly stark, almost unfathomable.
The pandemic had a materially adverse impact, and that's frankly an understatement. Demand for travel simply evaporated. It declined rapidly in the March 2020 quarter and remained significantly depressed throughout the entire year. The numbers are truly sobering. Delta reported a pre-tax loss of a staggering $15.6 billion for 2020.
$15.6 billion.
Billion, yes. To contextualize that, imagine this. That represented a massive $21.8 billion decrease compared to their robust performance in 2019. Revenue plummeted by an astonishing 64% year over year. This profound loss wasn't just operational. It included an $8.2 billion hit in restructuring charges, largely from early fleet retirements, and $2.4 billion in investment impairments and equity method losses.
What were those impairments mainly from?
Those losses stemmed primarily from writing down investments in partner airlines like LATAM, Grupo Aeromexico, and Virgin Atlantic, which themselves faced severe financial distress due to the pandemic. Even when you adjust for these specific extraordinary items, their adjusted pre-tax loss was still a substantial $9.0 billion. It speaks volumes about the sheer fragility of even a major airline in the face of a truly global, unprecedented shock.
That's a truly devastating picture. Let's break down that revenue plummet a bit further. Which regions or segments of their business were hit hardest in 2020? Was there any area that offered even a glimmer of resilience?
Well, passenger revenue, which is the absolute lifeblood of their business, was particularly devastated. In 2020, it stood at a mere $12.883 billion, a drastic drop from $42.277 billion in 2019. Breaking it down geographically, the impact was widespread but felt differently. Domestic passenger revenue, their largest segment, decreased by 67%.
Still massive, but less than international, I assume.
Exactly. International markets saw even steeper declines, reflecting tighter border restrictions and greater traveler hesitancy. Atlantic passenger revenue was down by a staggering 81%, Latin America by 63%, and Pacific by an almost complete wipeout of 78%. This illustrates the widespread and severe impact across their entire intricate network. The company openly highlighted that demand was expected to remain depressed until effective vaccines became broadly available, vaccination widespread globally, and critically, travel restrictions began to ease significantly. It truly underscores how external factors dictate the very survival of an airline.
Given that stark picture, what immediate and aggressive actions did Delta take to mitigate this impact? Beyond just hoping for a vaccine, what levers did they pull to keep the company afloat?
In response to this drastic revenue reduction, Delta implemented extensive and frankly aggressive cost-saving initiatives throughout 2020. A primary action was rapidly reducing capacity to align with the plummeting demand. This resulted in removing approximately 350 aircraft from active service by December 31st, 2020, and the early retirement of certain less efficient fleets.
Taking planes out of the sky.
Exactly. They also consolidated their airport footprint, which included temporarily closing some Delta Sky Clubs, a noticeable sign of the times for travelers. To manage employee-related costs, and crucially, without resorting to involuntary furloughs for their U.S. employees, which was a testament to their commitment, they offered voluntary unpaid leaves. These were taken by about 50,000 employees at various times throughout the year.
50,000 employees took unpaid leave. That's huge.
It is. Additionally, they offered early retirement and voluntary separation programs with around 18,000 employees participating. And critically, executive leadership also took very significant salary reductions from April through December 2020, including a 100% reduction for the CEO and 50% for officers. It sent a powerful message internally and externally. Beyond this, other discretionary spending was also delayed or simply eliminated wherever possible. Just survival mode.
That's an incredible set of actions, especially avoiding involuntary furloughs for the U.S. staff. But did government support also play a role in their financial strategy? It seems like many airlines relied heavily on that safety net during the crisis.
Yes, a very significant one, and it was absolutely critical for their survival and stability. Delta received substantial support through the Payroll Support Program, or PSP, extensions, which were part of broader government relief efforts. In January 2021, for example, they received $1.4 billion, with an additional $1.5 billion expected later in Q1 2021.
So nearly $3 billion just in early 21. How was that structured? Was it all loans?
No, and that's key. This support was uniquely structured, comprised of approximately 70% in grants money they didn't have to repay, and 30% in unsecured 10-year low-interest loans. So for that January 2021 payment, it was roughly $980 million in grants and $420 million in loans.
Grants make a big difference.
A huge difference. In connection with receiving these payments, Delta also issued warrants to the U.S. Department of the Treasury to acquire shares of Delta common stock. Think of these warrants as a kind of IOU, or a future option, for the government to buy a small slice of Delta stock at a set price. These warrants represented less than 0.5% of Delta's outstanding shares, with an initial exercise price of $39.73 per share, subject to adjustment in certain cases, and a 5-year term.
Interesting. So a potential upside for taxpayers if things turned around.
Exactly. It was a way for taxpayers to potentially benefit if Delta's recovery went well, adding another layer of accountability to the aid.
So beyond just the money, what were the specific conditions tied to this government aid? There must have been strings attached to such a substantial lifeline.
You're right, there were very strict conditions. The PSP extension law mandated that these funds were to be used exclusively for employee salaries, wages, and benefits. It explicitly prohibited involuntary terminations or furloughs for employees until at least March 31st, 2021. This was crucial for maintaining employee morale and readiness for when travel eventually rebounded.
So job protection was the main condition.
That was primary, yes. Furthermore, pay rates for employees earning salaries or wages could not be reduced without employee consent during this period, except in cases of permitted terminations or furloughs. The agreements also included transparency clauses, requiring recipients like Delta to report the total compensation for their 5 most highly compensated executives, which could then be made public on U.S. government websites like sam.gov.
Transparency on executive pay.
Yeah.
That's important when public money is involved.
Absolutely. It provided vital transparency into executive compensation practices when federal aid was involved. And critically, they prohibited the use of these federal funds for lobbying efforts related to the payroll support. These provisions were put in place to ensure accountability for the government aid, prevent any misuse of funds, and provide a clear framework for financial oversight, reflecting a commitment to safeguarding taxpayer interests.
Okay. How did the broader financial community, particularly the credit rating agencies, react to Delta's situation in 2020, given all this turbulence and the government intervention? What did that signal about their financial health?
Well, their credit ratings truly reflected the severity of the situation and the perceived risk. Standard & Poor's, a major rating agency, downgraded Delta's credit rating to BB in March 2020. Fitch, another key agency, followed suit with a downgrade to BB+ in April 2020. Both of these are considered junk bond status, below investment grade, signaling increased risk for lenders.
So 2 big downgrades to junk status. Did Moody's agree?
Interestingly, Moody's rating remained BAF3, which is still investment grade, the lowest tier, but investment grade nonetheless. So, a slight divergence in opinion among the agencies there. The sheer scale of the challenge also showed up on their balance sheet. Total debt and finance leases stood at a substantial $29.4 billion as of December 31st, 2020, significantly higher than pre-pandemic levels. This meant they faced significant scheduled maturities looming in the coming years, ranging from $3 billion to $5 billion annually from 2023 through 2025. These downgrades and the burgeoning debt indicated the market's cautious outlook on the airline's financial stability during that unprecedented period, making it more expensive for them to borrow money.
Right. Moving into 2021, after such a challenging year, what were the first signs of recovery for Delta, and how did their liquidity management, which was so crucial in 2020, begin to evolve?
2021 definitely saw a slow but discernible recovery begin to take hold, particularly driven by a resurgence in leisure travel. Delta's liquidity, that's their readily available cash, cash equivalents, short-term investments, and available revolving credit, actually increased to a healthy $14.2 billion as of December 31st, 2021.
Increased. Even in 21. How?
Well, this was an impressive $8.2 billion increase compared to December 31st, 2019, before the pandemic hit. It was primarily thanks to proceeds from the loans and debt issuances they undertook to bolster their financial position during 2020. Operating activities actually provided $3.3 billion in cash during 2021, largely from the substantial $4.5 billion in those payroll support program grants we just discussed.
So the grants flowed through positively.
Yes, though it's worth noting this was partially offset by significant pension plan contributions of $1.5 billion, a large cash outflow. They also made substantial debt and finance lease repayments, including approximately $3.8 billion in early repayments alongside scheduled maturities. This demonstrates a concerted and early effort to manage and reduce their financial obligations despite the ongoing recovery.
Already starting to pay down debt in 21. That's proactive.
Absolutely. It shows a strategic shift from simply surviving to actively strengthening their balance sheet.
Beyond passenger revenue, which was slowly coming back, what other segments showed growth and strength for Delta in 2021? What surprised you about their diversified strategy during this period?
It's fascinating how their other revenue streams really stepped up in 2021. Their unique refinery segment, Monroe Energy, saw third-party sales increase by a remarkable $2.1 billion. That represents a phenomenal 181% increase compared to 2020.
Wow. Why such a huge jump at the refinery?
This wasn't just about more fuel sales. It was primarily due to the refinery strategically shifting its focus to producing and selling more non-jet fuel products, like gasoline or diesel, because demand for jet fuel remained lower than historical levels. Coupled with higher pricing for these products, it truly highlighted the adaptability and strategic value of their diversified business model.
So they made more money selling gasoline than jet fuel, essentially.
In a way, yes, through those third-party sales and exchanges. And then there's their loyalty program revenue, which is a consistent powerhouse. This revenue, mainly driven by customer spend on American Express co-brand cards and new cardholder acquisitions, increased by a solid 21% to $1.77 billion. This segment continued to be a strong performer, providing a valuable high-margin revenue stream that's somewhat independent of direct flight operations.
The Amex partnership really is gold for them, isn't it?
It really is. Even ancillary businesses, which include aircraft maintenance services provided to third parties and their vacation wholesale operations, saw a solid 22% increase in revenue. These diversified income streams were absolutely crucial during the early stages of the recovery.
So as the recovery started, what about capital expenditures and fleet management in 2021? Were they still investing heavily during what was still a fragile period?
Yes, they were, indicating a renewed confidence and a long-term strategic outlook. Capital expenditures increased significantly to $3.2 billion in 2021 from $1.9 billion in 2020. These funds were primarily allocated to essential areas: aircraft purchases, ongoing airport construction projects, those massive overhauls we often hear about, necessary fleet modifications, and critical technology enhancements to improve customer experience and operational efficiency.
So investing across the board. Any big fleet decisions?
Yes, what's notable is that Delta also converted options for 55 A321neo aircraft into firm orders and replenished 25 of their options, with deliveries expected to begin in the first half of 2022 and continue through 2027. It's a huge commitment to fleet modernization. They also strategically moved up deliveries of 2 A350-900 aircraft and 1 A330-900neo aircraft to the second half of 2022. This signals a clear belief in a continued rebound in future demand and a commitment to having a modern, fuel-efficient fleet ready for it.
Transitioning to 2022, as the world continued to open up, how did Delta's focus on balance sheet strength and network development truly contribute to its performance? What was their financial North Star?
Restoring balance sheet strength and aggressively reducing debt became the key financial priority for Delta in 2022. They repaid approximately $4.5 billion in debt and finance lease obligations, maintaining a very clear and vocal commitment to regaining investment-grade metrics. This was crucial for lowering their borrowing costs and improving their long-term financial stability.
So doubling down on debt repayment.
Absolutely. Simultaneously, they continued to invest heavily in their fleet, taking delivery of 69 aircraft. This included a mix of new A321neos, A220s, A330-900s, and A350-900s, alongside some pre-owned regional jets and 737s. And here's a critical insight. These new aircraft were, on average, 25% more fuel efficient per seat mile than the retiring aircraft, directly aligning with both operational efficiency goals and their environmental sustainability commitments.
25% more efficient. That adds up quickly.
It really does. And in July 2022, they further solidified their long-term fleet strategy, looking far into the future, by entering into a purchase agreement with Boeing for 100 Boeing 737-10 aircraft. That's the largest model in the 737 MX family. Deliveries start in 2025, and they have an option for 30 more. This isn't just about replacing old planes, it's about optimizing their fleet for the next decade.
Okay. Their global network is strongly supported by a web of strategic alliances. What was the status of these crucial partnerships in 2022, and why are they so vital to Delta's overall strategy?
Delta has indeed diversified its business significantly and extended its global reach through these strategic relationships, which are far more than just code-sharing agreements. In 2022, they continued their combined joint venture with Air France, KLM, and Virgin Atlantic for transatlantic traffic. Beyond this commercial agreement, Delta holds a non-controlling 49% equity stake in Virgin Atlantic Limited and a 3% ownership stake in the parent company of Air France and KLM. These are deep structural ties.
So they actually own pieces of their partners.
In some key cases, yes. Their joint cooperation agreement with Aeromexico for trans-border traffic between the U.S. and Mexico also continued strongly, with Delta holding an approximately 20% equity stake in Grupo Aeromexico after Aeromexico emerged from Chapter 11 bankruptcy in March 2022. This demonstrates commitment through a partner's difficult period.
Sticking with them through bankruptcy.
Right. And a joint venture agreement with Elatum, completed in November 2022, provided Delta crucial access to over 300 destinations between North and South America, with Delta acquiring an approximately 10% equity stake upon LATAM's restructuring completion. Lastly, a joint venture with Korean Air covered traffic flows between the U.S. and Asia, with Delta owning just under 15% of Hanjin, the largest shareholder of Korean Air. These alliances are truly fundamental to their global reach, allowing them to offer seamless travel and expanded market access without owning every single route or aircraft, significantly enhancing their competitive position.
We've discussed Delta's unique refinery, Monroe Energy, as a key strategic asset. How did it perform in 2022 as travel started to normalize, and how did it continue to play its critical role?
As travel started to normalize in 2022, Monroe refinery operations notably returned to pre-pandemic levels, maintaining its robust capability of refining approximately 200,000 barrels of crude oil per day. What's fascinating is how they continued to strategically use agreements to exchange the non-jet fuel products the refinery produces, things like gasoline, diesel, and lubricants, with third parties for the jet fuel consumed in airline operations.
So that exchange mechanism was still key.
Very key. The gross fair value of these exchange products reached a significant $3.5 billion in 2022, showing a substantial increase from $2.3 billion in 2021 and $1.5 billion in 2020. This indicates the refinery's crucial and growing role in mitigating jet fuel costs. It's not just producing fuel, it's a sophisticated financial lever, effectively managing their output and securing necessary fuel supplies for the airline, creating a unique hedging mechanism against market volatility.
What about Delta's investment in its most valuable asset, its workforce, and in technology during 2022? How do they prioritize these crucial areas as they bounce back?
Delta truly prioritized investing in its people and technology in 2022, understanding these are foundational to future success. They embarked on a significant hiring spree, bringing in approximately 25,000 new team members. This massive influx reflected the rebuilding and expansion of airline operations as demand rebounded.
25,000 new hires, that's rebuilding fast.
It is. And this investment in human capital wasn't just internal, it was recognized externally. Forbes, for instance, listed Delta as number 6 on its list of the world's best employers for 2022, making it the highest-ranked airline on that global list. Glassdoor also named Delta one of the best places to work for the 6th consecutive year, ranking at number 18 on their list of 100 large companies. These accolades speak volumes about their workplace culture.
So people wanted to work there. What about tech?
On the technology front, they continued to pour resources into enhancements for customer-facing applications. Think the Fly Delta app you use to check in, and significant improvements to their underlying infrastructure and technology architecture. The overarching objective was digital transformation, aiming to unify and improve access to their vast data sources, allowing for more personalized service and strengthening the brand experience for customers at every touch point. It's an investment in efficiency and customer loyalty.
And profit sharing, a key part of their employee compensation and a hallmark of Delta's culture, made a strong comeback in 2022. What did that look like?
Yes, the broad-based employee profit-sharing program, which is a major part of Delta's compensation philosophy, returned strongly. Delta recorded a substantial $563 million in profit-sharing expense based on its 2022 pre-tax profit. This significant amount was paid out to employees in February 2023, directly linking their hard work to the company's financial success.
Over $500 million in profit sharing. That's significant.
It is, and this followed a special $108 million payment that had been made in February 2022, which was based on the adjusted pre-tax profit earned during the second half of 2021. This earlier payment was an important gesture, recognizing the extraordinary efforts of employees through the particularly difficult initial pandemic recovery phase. It's a powerful incentive that aligns employee interests directly with the company's profitability.
Looking at the bigger picture, how did Delta's stock perform compared to the broader market and its airline peers during this period? It's often a telling indicator.
Yeah, the stock performance graph provided in Delta's 2022 10K offers a very clear comparative view of Delta's common stock performance from December 31st, 2017 to December 31st, 2022. Over this 5-year period, what we observe is that Delta's cumulative total returns underperformed both the broader S&P 500 index, or SPX, and notably its direct industry peers, represented by the NYSE RCA Airline Index, or XAL.
So lagging both the market and other airlines over those 5 years.
This underperformance primarily reflects the profound and unprecedented impact of the COVID-19 pandemic on the entire airline industry in 2020, which essentially shut down air travel. While the company made truly significant strides in its operational and financial recovery in 2021 and 2022, the sheer depth of the initial shock meant that its cumulative returns did not quite keep pace with the broader market or even its direct industry competitors over this specific 5-year timeframe. It's a powerful reminder of how quickly external shocks can recalibrate a company's trajectory.
Right, that hole from 2020 was deep.
Okay.
Okay, moving into 2023. As the recovery solidified, what were the standout achievements for Delta in terms of both financial performance and critically operational excellence?
Delta continued its strong recovery trajectory in 2023, and it was marked by significant achievements on multiple fronts. They continued to reward employees handsomely, distributing substantial profit-sharing payments of $1.4 billion for 2023.
$1.4 billion, even bigger than the year before.
Exactly. A clear signal of their commitment to aligning employee interests with the company's success. Additionally, employees earned an extra $53 million under the Shared Rewards Program, an initiative specifically designed to incentivize and reward exceptional operational performance. Speaking of operations, Delta consistently maintained its industry-leading reliability. They earned the prestigious Cerium Platinum Award for Global Operational Excellence for the 3rd consecutive year in January 2024, confirming their status as a top performer on a global scale.
Best of the world operationally, 3 years running.
According to Cerium, yes. And on the domestic front, the Wall Street Journal recognized Delta as the top U.S. airline for 2023 for the 3rd consecutive year in its annual airline scorecard. This was specifically for their leadership in on-time arrivals and minimizing involuntary denied boardings. This consistent external recognition truly underscores their unwavering focus on operational efficiency and a superior customer experience.
That consistent operational excellence is impressive. But how did their revenue streams evolve in 2023, especially with premium products and that unique refinery segment? Any surprises there?
Revenue evolution in 2023 clearly showed a strategic and successful pivot towards higher value offerings. Premium yield growth significantly outpaced main cabin, meaning the revenue they generated from business class, first class, and other premium cabins grew faster than standard economy seats. They also achieved record paid load factors in their premium cabins, indicating incredibly strong and growing demand for these higher margin products.
So people were willing to pay more for better seats post-pandemic.
It certainly seems so. A notable 62% of tickets were sold through direct channels, including the incredibly successful Fly Delta app, which impressively surpassed 1 billion visits in 2023. This direct channel strategy is key. It helps them reduce distribution costs by bypassing third-party booking sites and allows for much more personalized customer interactions, strengthening brand loyalty.
Makes sense. What about the refinery in 23?
The refinery segment, however, saw a decrease in third-party sales by $1.6 billion compared to 2022. This was primarily attributed to two factors: lower pricing for refined products in the broader market, and a significant turnaround operation completed between September and November 2023, which impacted production volumes. Furthermore, a fascinating regulatory nuance came into play. The EPA's finalized Renewable Fuel Standard, or RFS, volume requirements for 2023-2025 were actually below projected production of transportation fuels. This resulted in a decrease in REM prices, renewable identification numbers, which are essentially credits needed for compliance, negatively impacting the refinery's compliance costs and overall profitability. It's a complex interplay of market, operations, and regulation.
Wow, so even EPA regulations impacted the refinery's bottom line. Complex stuff.
It really is.
So on the cost side, how did their overall cost structure look in 2023, particularly concerning fuel, which is always a massive variable for an airline? And how did their non-operating results fare?
On the cost side, there was good news overall. Total operating cost per available seat mile, or KSM, think of it as their efficiency score, for every seat they fly 1 mile, actually decreased by 4% compared to 2022, settling at 19.31 cents. This improvement was primarily driven by a substantial 17% increase in capacity, which allowed them to spread their fixed costs over more available seats, leading to better absorption. This was coupled with lower fuel expense.
So overall efficiency improved. But any catches?
Well, there's a nuance here. Non-fuel unit costs, or KSMX, which excludes the volatile fuel and refinery-related expenses, actually increased by 2.3% to 13.17 cents. This indicates some underlying inflationary pressures on other operational expenses, like labor and maintenance, even as overall efficiency improved.
Got it. And fuel costs themselves.
Fuel expense itself saw a decrease of $413 million compared to 2022. This was a direct result of an 18% decrease in the market price of jet fuel, which was a significant tailwind for the company, though partially offset by a 15% increase in consumption aligned with their capacity restoration. On the non-operating side, there was a truly significant turnaround. Total non-operating income was $87 million in 2023, a substantial improvement from the $1.7 billion expense recorded in 2022.
From a $1.7 billion expense to income, what drove that?
This positive shift was mainly due to mark-to-market gains on certain equity investments, meaning the value of some of their other investments, like stakes in partner airlines, went up significantly on paper even if they hadn't sold them, and lower interest expense from their debt reduction initiatives. This was partially offset by increased pension-related expenses. It's fascinating how a company of this scale can still be so sensitive to fluctuations in global energy markets and the strategic decisions around its varied investments.
Absolutely. Speaking of investments, how did their equity investments, their stakes in other companies, perform in 2023? It sounds like a bit of a mixed bag, with some bright spots and some lingering challenges.
Indeed, it was a truly mixed picture. The carrying value of their equity investments collectively increased to a healthy $3.457 billion at year-end 2023 from $2.128 billion in 2022. This aggregate figure includes their interests in a range of strategic partners: Air France-KLM, China Eastern, Clear, Grupo Aeromexico, Anjun-Call, LATAM, Unify Aviation, and Wheels Up.
So the overall value went up. Any specific standouts or laggards?
Notably, their equity interest in Wheels Up, a private aviation company, increased to 38% after a cash contribution. However, despite this larger stake, Delta determined it is not the primary beneficiary for consolidation purposes, meaning Wheels Up's financials are not fully integrated into Delta's, which is an important accounting distinction. The carrying value of their investment in Virgin Atlantic, on the other hand, remained at zero. Delta continues to hold a 49% equity interest in Virgin Atlantic, but still has approximately $400 million of unrecognized equity method losses related to that interest.
Still carrying losses from Virgin Atlantic.
Right. These losses will only be recorded if Delta makes additional investments in Virgin Atlantic, or if Virgin Atlantic returns to profitability. This highlights both the upside potential and the ongoing challenges of their strategic equity partnerships. Some are thriving, others are still recovering from the pandemic's impact.
And what about their debt and lease obligations as of late 2023, after all that concentrated effort to strengthen the balance sheet? Where did they stand?
By December 31st, 2023, Delta had $16.8 billion in fixed-rate debt, $1.9 billion in variable-rate debt, and $583 million in variable-rate leases. A significant financial milestone they achieved was their complete transition away from LIBOR-based debt and finance leases. They had successfully transitioned to SOR, the Secured Overnight Financing Rate, or other index rates, essentially de-risking their exposure to the phase-out of LIBOR, which was a major industry-wide undertaking.
Okay, getting off LIBOR is good. Any other debt details?
Well, their debt agreements include important covenants, which are essentially financial promises Delta makes to its lenders. For instance, they have a minimum liquidity covenant requiring at least $2.0 billion in cash and available credit, which they consistently met, reassuring their creditors. Total lease cost was $3.620 billion in 2023, showing a continued increase from $3.254 billion in 2022 and $2.893 billion in 2021. This reflects their ongoing reliance on leased aircraft and facilities to support their growing operations, and its significant recurring expense.
Looking ahead to 2024, what were the projections and key considerations regarding Delta's financial position based on the reports available at the time? What challenges and opportunities were on the horizon?
For 2024, Delta expected elevated jet fuel prices compared to historical levels. This is a critical projection, driven by ongoing market conditions and geopolitical events, a constant area of volatility for the airline industry. Fuel consumption was also projected to increase in line with their planned capacity restoration as they continue to fly more, though this increase was partially offset by continued improvements in fleet fuel efficiency from their modernized aircraft.
So higher fuel prices, but better efficiency helping offset it. What about obligations?
Regarding employee benefit plans, projected pension benefit obligations at the end of 2024 were anticipated to be $14.967 billion, a slight decrease from $15.911 billion at the end of 2023, signaling a more manageable long-term liability. Pension benefit payments for 2024 were projected at $1.259 billion. Additionally, as of December 31st, 2024, Delta had total minimum operating lease obligations of $8.4 billion, with annual payments ranging from $600 million to $1.0 billion over the next 5 years. Other significant purchase obligations for goods and services totaled approximately $9.3 billion, with annual payments ranging from $400 million to $1.3 billion over the next 5 years. These large figures indicate substantial future commitments for operational needs and continued growth, highlighting the long-term planning required in this industry.
Let's zoom out now and look at some of the consistent themes and key financial metrics that shape Delta's performance across this entire fascinating period, from the depths of 2020 through the strong recovery into 2024. How do their various revenue streams consistently contribute to the overall picture during this incredibly volatile time?
Well, passenger revenue, as we've firmly established, remained Delta's absolute core. We observed an extraordinary rebound from the pandemic's low point of $12.883 billion in 2020. That figure then soared to $40.218 billion in 2022, and further still to an impressive $45.926 billion in 2023. This trajectory vividly illustrates the incredibly strong and rapid recovery in travel demand once restrictions eased.
That passenger rebound is just incredible. But what about the other parts?
Right, but what's truly remarkable is the consistent stability and growth of their loyalty program, notably driven by the American Express co-brand card. This proved to be a high-margin, stable revenue source that acted almost as a financial cushion during the downturn and a significant accelerator during the recovery. Cash sales from these marketing agreements, largely from American Express, steadily increased year over year, from $2.9 billion in 2020 to $4.1 billion in 2021, $5.7 billion in 2022, and reaching a phenomenal $6.8 billion in 2023.
$6.8 billion just from Amex marketing in 23. That's massive.
It is. In 2023 alone, this loyalty segment generated $3.093 billion in revenue for Delta, demonstrating its growing importance. Refinery sales to third parties fluctuated significantly, as we touched on. They increased by $2.1 billion in 2021, when the refinery strategically shifted to non-jet fuel production, but then decreased by $1.6 billion in 2023 due to lower market pricing and that planned operational turnaround. Ancillary businesses, such as aircraft maintenance services provided to third parties, and their vacation wholesale operations, along with cargo operations, also consistently contributed to revenue, truly highlighting the diversified nature of Delta's business beyond just selling passenger tickets. It's a complex, multifaceted revenue engine.
Fuel costs are a perpetually major factor for airlines, given their operational nature and reliance on jet fuel. How did this volatile expense impact Delta across these years, and what strategies did they employ to try and mitigate its swings?
Fuel expense remained a profoundly volatile and material cost, consistently representing a significant portion of Delta's total operating expense, around 21% in 2023, for example. The average annual fuel price per gallon, even including their hedging strategies, varied dramatically throughout this period. For instance, in 2022, fuel expense soared by a massive $5.8 billion compared to 2021. This was primarily due to a huge 78% increase in the market price of jet fuel globally, coupled with a 23% increase in consumption as capacity was restored.
A $5.8 billion jump in 1 year just from fuel.
Ouch! Exactly. In stark contrast, 2023 saw a welcome decrease in fuel expense by $413 million. This positive shift was driven by an 18% decrease in market price, despite a 15% increase in consumption as they continued to expand operations. Delta also incurred costs for carbon offsets, a growing area of expense. They spent $95 million in 2021 for 2020-2021 emissions and $116 million in 2022 for 2021-2022 emissions.
Are offsets still their main environmental strategy?
Well, here's a crucial strategic shift. Their future investment strategy is notably moving away from simply purchasing carbon offsets toward more direct and impactful decarbonization solutions, such as investments in sustainable aviation fuel, SAF. This emphasizes a long-term commitment to addressing greenhouse gas emissions directly, rather than just offsetting them.
Okay, a shift towards SF. What about other operating expenses, particularly maintenance and labor, which are also very substantial for any major airline? How did these costs fluctuate? And how did Delta manage them through the crisis and recovery?
Aircraft maintenance materials and outside repairs increased notably in 2021 compared to 2020. This was a direct and understandable consequence of aircraft being returned to service following reduced capacity during the pandemic. When planes sit idle, they still need maintenance, and then they need even more once they're reactivated to ensure operational reliability and safety.
Makes sense. And labor, always a big cost.
Immensely significant given the labor-intensive nature of the airline business. As of December 31st, 2022, approximately 20% of their workforce, primarily pilots, was unionized, which means a different dynamic for wage negotiations. The collective bargaining agreement with their pilots became amendable on December 31st, 2019, leading to ongoing, complex discussions through the pandemic. A tentative agreement was eventually ratified in January 2023, subject to pilot ratification by March 1st, 2023, which finally provided some long-term stability in their largest unionized workforce.
Getting that pilot contract done must have been a relief.
Oh, absolutely. To manage these substantial labor costs during the pandemic's peak in 2020, Delta implemented aggressive voluntary employee programs, such as offering widespread unpaid leaves and early retirement separation options, which many employees took up. They also enacted significant temporary salary reductions for leadership and reduced work hours for other management and frontline groups, demonstrating truly aggressive cost management in the face of an unprecedented crisis.
Considering their balance sheet, how did Delta strategically manage its debt and overall liquidity through this incredibly challenging period? It sounds like a constant juggling act.
It absolutely was a monumental juggling act. Delta's principal amount of debt and finance leases started at a very high point, $29.4 billion at December 31st, 2020. This was a direct consequence of pandemic-era financing designed to maintain liquidity and survive. But they then made truly significant strides in debt reduction, showing a disciplined commitment to deleveraging. This figure decreased to $21.381 billion in 2022, and further still to $18.61 billion in 2023.
Dropping over $10 billion in debt in 3 years. Impressive.
Very impressive. This aggressive debt reduction was a stated priority. However, they also faced substantial scheduled debt maturities, ranging from $3 billion to $5 billion annually from 2023 to 2025, so this was not a one-and-done effort. Liquidity, which is their cash on hand, cash equivalents, short-term investments, and available revolving credit, was critically important for operational flexibility. It stood at a robust $16.7 billion at the end of 2020, providing a crucial buffer. This then strategically decreased to $14.2 billion at the end of 2021 and $7.6 billion at the end of 2023, showing a deliberate drawdown from peak levels as operations stabilized and debt was repaid, indicating they felt more financially secure.
So they felt comfortable holding less cash as things improved.
Exactly. While their credit ratings were impacted by the pandemic, with downgrades from S&P and Fitch in 2020, the company remains explicitly committed to regaining investment-grade metrics, which would lower their future borrowing costs and signal strong financial health.
Let's talk about the significant investments in airport redevelopment, especially at JFK and LaGuardia in New York. These are massive, multi-year projects. What's the scale of these undertakings, and what's their strategic importance to Delta?
These are indeed monumental undertakings that reflect truly significant capital investment in long-term infrastructure and customer experience. At New York JFK Terminal 4, Delta has been extensively enhancing and expanding facilities to strengthen its competitive position and offer a premium travel experience in one of the world's busiest airports. This project involves adding 10 new gates, an additional Delta Sky Club, and a brand new Delta One lounge for their premium travelers. The estimated cost for this ambitious project is approximately $1.6 billion, funded primarily by bonds issued by the New York Transportation Development Corporation, with Delta's portion substantially completed by early 2024 and operations largely consolidated to Terminal 4.
$1.6 billion just at JFK. What about LaGuardia? That seemed even bigger.
It was. The New York LaGuardia Airport redevelopment was an even larger and more complex undertaking, with an estimated total cost of $4.3 billion for the entire project. By December 31st, 2023, approximately $3.7 billion had already been spent on this massive endeavor, with Delta's net project cost expected to be around $3.8 billion. Delta funded a significant portion of this construction through specific loan agreements, which are recorded as debt on its balance sheets. These projects aren't just about shiny new terminals, they highlight the considerable long-term capital commitments an airline makes to modernize its facilities, enhance customer experience, and improve operational efficiency for decades to come, while also bearing the inherent risks of construction, including potential cost overruns and delays.
Finally, as we assess Delta's financial health, what are some of the key risk factors that Delta explicitly highlights in its own reports? What should investors or anyone interested in the company be aware of, even amidst the recovery?
Delta identifies a comprehensive range of risks in its public filings, reflecting the dynamic and often unpredictable nature of the airline industry. Cybersecurity breaches are a constant and evolving threat. Given the sheer volume of sensitive customer and operational data they handle, any compromise could result in significant legal claims, hefty regulatory penalties, major operational disruption, and severe reputational damage.
Cyber risk is always top of mind these days. What else?
Labor-related disruptions, such as strikes or other collective actions, can materially affect operations, especially with a significant portion of their workforce unionized. A pilot strike, for example, could ground the airline. Fluctuations in aircraft fuel prices are always a major concern, as fuel is a primary operating expense and highly volatile due to global market conditions and geopolitical events. Just think about the impact of the past few years.
Fuel prices. Got it.
Yeah.
Geopolitics.
Yes, geopolitical conflicts or terrorist attacks, and even the fear of such events, remain high-profile threats that could significantly depress travel demand or disrupt their complex global operations. Regulatory changes related to environmental sustainability, such as evolving carbon emission standards like CORSIA and EU ETS, or mandates for sustainable aviation fuel, SAF, could impose significant compliance costs and impact fuel prices further.
The environmental regulations could bite.
They could. Their dependence on a limited number of aircraft and engine manufacturers, Boeing and Airbus primarily, also poses operational risks if groundings or defects occur across a fleet. Lastly, antitrust litigation, like the consolidated class action lawsuit alleging capacity restraint in the U.S. airline industry, remains an ongoing legal challenge that could impact their operations and financial results. These are all factors that Delta explicitly identifies as having the potential to materially adversely affect their business, even as they recover.
Okay, a lot to keep an eye on there. Now let's shift our financial analysis to the ownership structure of Delta Airlines. Who are the key players when it comes to holding DAL stock, and what can we infer from their activity?
Right. We can examine this through two key lenses: insider trading and institutional holdings. Starting with DAL insider trading data, this information is meticulously parsed from SEC Form 4 filings, which are public disclosures required when company insiders buy or sell stock. This provides unique insights into trades made by individuals with privileged access to company information, including members of the U.S. Congress, as well as Delta's own directors and management.
Now, how much weight should we put on these insider trades?
That's the crucial question. It's vital to remember that these are individual trades, often driven by personal financial situations, diversification strategies, or compensation structures like stock options. They're not necessarily indicative of broader market trends or specific non-public knowledge, but they do offer a unique window into sentiment from those closest to the company or legislative developments impacting the industry. Observing patterns over time can be part of a broader analytical picture, but you can't read too much into single trades.
Okay, patterns over time. Can you give us some illustrative examples from the congressional trading data that always garners a lot of attention?
Certainly. The QuiverQuant data provides a compelling look at numerous transactions involving members of Congress. For instance, Jefferson Shreve, a Republican from the House, shows sales in May 2025 and March 2025, each in the $15,001 to $50,000 range. Ro Khanna, a Democrat from the House, exhibits more frequent activity, reflecting perhaps more active trading style. He shows several sales in April, March, and January 2025, but also, significantly, purchases in April 2025 and previously in October 2024, July 2024, and October 2023. These transactions for Khanna are typically in the $1,001 to $15,000 range.
So some buying, some selling from Khanna. Any others?
Robert Bresnahan, a House Republican, had a purchase in April 2025, also in the $1,001 to $15,000 bracket. Other notable trades include sales by Morgan McGarvey, a House Democrat, in July 2024, and Daniel S. Goldman, also a House Democrat, in March 2023 for a $15,001 to $50,000 amount, following a purchase in January 2023 of the same range.
Okay. What about those trades during the early pandemic? You mentioned those earlier.
Right. What's particularly striking and often discussed are some of the trades during the early pandemic period. In April 2020, for example, during the initial chaos and the passage of critical government aid legislation like the CARES Act, we saw sales by Kelly Loeffler, a Senate Republican at the time, including 2 full sales in the $50,001 to $100,000 range, and David Perdue, another Senate Republican then, with a full sale in the $1,001 to $15,000 range. Loeffler also made purchases in the $100,001 to $250,000 range on April 7, 2020.
Interesting timing around the CARES Act and PSP discussions.
Indeed. What's fascinating here is the timing of some of those early pandemic trades by certain congressional members, coinciding with critical moments for the airline industry and the passage of the payroll support program. While we cannot infer specific motivations or inside knowledge, observing these patterns can be part of a broader analysis of how different groups, especially those with proximity to legislative changes, react to market conditions.
Okay. Beyond congressional members, what about Delta's own corporate insiders, its directors and management? Do we get a clearer picture of their activity, and how important is that to understand?
Well, the DAL insider trading source specifically references quarterly net insider trading by DAL's directors and management. While the detailed transaction data for these specific individuals isn't explicitly laid out in the provided sources in the same granular way as for Congress, the presence of this category is immensely significant. It indicates that tracking purchases and sales by these key individuals, those directly responsible for the company's strategic and operational decisions, is a standard and important part of assessing insider sentiment.
So what does that data generally tell us?
This data, also parsed from SEC Form 4 filings, offers a direct look at how those closest to Delta's core operations are adjusting their personal holdings. If directors and senior management are net buyers, consistently acquiring shares, it might signal strong confidence in the company's future prospects. Conversely, consistent net selling could suggest the opposite. Although, again, it's always crucial to consider that personal financial planning, diversification, and compensation structures, like stock options vesting, often heavily influence these trades. So you look for sustained patterns rather than one-off transactions.
Patterns again. Okay. And what about larger institutional investors? How much of Delta is held by big funds or organizations? And how does their collective activity, often dubbed whale activity, impact the stock?
The sources mention DAL stock institutional owners and DAL derivatives institutional owners, along with whale activity, which is indeed the term for recently reported changes by these large institutional investors. While specific lists of these institutional holders or their exact share counts aren't provided in detail in our sources, the existence of these categories means that large investment funds, mutual funds, pension funds, and other significant financial organizations collectively hold a substantial portion of a publicly traded company like Delta.
So the big money matters.
Absolutely. Their buying or selling activity, often termed whale activity, due to its potential market impact, can significantly influence the stock's performance. When a major fund adds or divests a large position, it can send a strong signal and create momentum. These institutions frequently acquire common stock for long-term positions, reflecting a belief in the company's fundamental value, or engage in derivatives, such as options, to manage their positions and exposure, whether for hedging risk or for speculative purposes. The movements of these large players are always closely watched because they can indicate major shifts in professional investor sentiment and capital allocation, providing a layer of insight into broader market confidence in Delta.
Are there any overall scores or assessments that try to summarize the strength of Delta's underlying data beyond just individual trades and large institutional movements? Something that tries to synthesize it all?
Yes, The DAL StockSmart score is highlighted as one such comprehensive assessment tool. This score, typically on a scale of 1 to 10, aims to provide a holistic view of the stock's underlying data strength by combining information from various disparate sources. These include, as we've discussed, Congress trading data, but also lobbying activity, which can indicate a company's influence on policy, or regulatory shifts, it's tracking insider trading by management, mentions in major financial media like CNBC, and more.
So it pulls a lot of different signals together.
Exactly. While the actual score for DAL isn't provided in our specific sources, the concept behind it is to synthesize these diverse data points into a single, digestible metric for quick assessment. It's essentially an attempt to quantify the collective signals emanating from different insider activities and external perceptions, offering a summarized, data-driven view of the stock's overall sentiment or underlying strength, giving you a quick snapshot of how various indicators are aligning.
Okay. And what about the broader governance framework of Delta, particularly in relation to the significant government support they received during the pandemic? How did that affect transparency and accountability for such a large public company?
The Payroll Support Program Extension Agreement outlines incredibly strict governance requirements that Delta, as a recipient of substantial federal aid, had to adhere to. For example, it mandates that if the total payroll support received is $25,000 or more, which Delta certainly received, the recipient must report the total compensation for its 5 most highly compensated executives for the preceding fiscal year.
Ah, the executive pay disclosure we talked about earlier.
Right. This information, as we touched on earlier, can then be made public on U.S. government websites like sam.gov, ensuring a crucial degree of transparency into executive compensation practices when federal aid is involved. It was a direct response to public demand for accountability. The agreement also details very clear terms around compliance with anti-corruption laws and sanctions, reinforcing legal and ethical conduct. Crucially, it specifically prohibits the use of federal funds received through the program for lobbying efforts related to the payroll support itself. These provisions were meticulously put in place to ensure robust accountability for government aid, prevent any misuse of taxpayer funds, and provide a clear framework for financial oversight, reflecting a deep commitment to safeguarding public interest during a national crisis.
So what does this all mean when we bring it all together? Our detailed financial analysis of Delta Airlines from 2020 to 2024 paints a truly remarkable picture of resilience and strategic adaptation. From navigating the unprecedented challenges of a global pandemic, which nearly grounded the entire industry, with significant government support and aggressive cost-cutting measures, to a robust and impressive recovery driven by powerful loyalty programs, continuous fleet modernization, and crucial strategic alliances, Delta has demonstrated an incredibly dynamic and agile response to a highly volatile environment.
Indeed. We've seen their financial health not just rebound, but strengthen significantly, characterized by substantial debt reduction and a renewed, consistent profitability. The detailed insights from insider and institutional ownership, while not prescriptive for individual investment decisions, certainly offer a fascinating glimpse into the market sentiment and the actions of those closest to the company's future. It's a complex interplay of relentless operational efficiency, an astute understanding of market conditions, and truly strategic financial management. Their consistent, forward-looking investment in fleet renewal and massive airport infrastructure projects, alongside managing a truly unique asset like their own refinery operation, truly sets them apart and positions them for the long haul.
Here's where it gets really interesting. What stands out to you about how a major airline like Delta responded to what was arguably the most significant disruption in modern aviation history? And looking forward, how might their long-term investments in areas like sustainable aviation fuel, their expanding premium products, and those massive airport infrastructure overhauls shape their competitive advantage in the decades to come? It's more than just bouncing back. It's about fundamentally reshaping for the future.
This raises an important question and a truly thought-provoking one. How will the ongoing external factors, such as unpredictable geopolitical events continuing to impact fuel prices, evolving global environmental regulations, and the race towards decarbonization, or even the subtle signals from insider trading patterns, continue to influence Delta's trajectory? It's a continuous, delicate balancing act between their internal strategic prowess and the powerful external forces they operate within. It truly makes you ponder the future of air travel, especially how a company with such a complex and diversified operational and financial structure continues to navigate both predictable headwinds and completely unforeseen storms.
Remember, this financial analysis is strictly for informational and educational purposes. We've dug deep into the available data, but you should always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thank you for joining us for this financial analysis on the Deep Dive. We hope this has given you a clearer, more insightful understanding of Delta Airlines and the incredible journey it has taken.